Welcome everyone to the Futures Workshop. Today we are going to do day one. It is May 31st, and we're going to be breaking down day one of the Futures Workshop, where I want to share with you guys a lot that I've learned over the years, right? I want to share with you guys a few very key, simple processes and tools that I use that you might have seen everywhere pretty much on our socials, wherever we post value and information. You probably already know what this is all about, but I want to do a deeper dive in that and give you an idea, right? Give you a baseline and some confidence to trade any market condition using very simple tools. So regardless of the volatility, regardless of how much volume there is in the market, especially in summer markets, right? We're entering into a season of seasonality where markets drop off and a lot of big traders and finance guys, they just go on vacation and the volume dries out of the market. So these strategies and systems are meant to be used in any market condition. It's not one specific market condition that you can use this. You don't need volatility, you don't need direction, you don't need trend. And I'm going to help you guys identify all of those aspects. So today's just part one. What we're doing is a 5-part series. I'm going to break down all 5 parts very soon, but it's going to be today, tomorrow, the day after, right? 5 consecutive days all throughout. So I hope you guys are super excited about that. Today is going to be a very basic introduction to futures, futures trading, and there's going to be a lot of talk about what it is that I found to be the only basic things that you need to get you started. So it's a great tool to kind of weed out all of the garbage that I found in the futures market and show you guys the things that actually matter in order to read how market participants actually interact with the markets. So the layout of this workshop, 5 total days are going to be consecutive. Day one today, we're going to be talking about the introduction to futures trading. Tomorrow, we're going to be going through the introduction to futures markets and participant psychology, how big players, strong-handed market participants actually move the markets, and how you can identify where their positioning is and where you can anticipate stops and larger moves. Then we're going to be going through day 3, which is the introduction to futures movement profiles and distributions. This is one of my favorite base concepts that I think everyone should understand in terms of market directionality and building confidence in the direction of market movement. Day 4, maybe what a lot of you are here for, is introduction to order flow and reading the depth of market. Again, a vital tool that I found for futures trading. And then day 5, the introduction to developing as a futures trader. I'll share with you guys a lot of things that I've learned along the way that can help you get from maybe struggling places or places to, or maybe you're in a place where you want to get to that next level. So a lot of these thoughts and ideas are going to be shared throughout this. So what's our goal throughout all of this, right? I want to break down how to navigate any market condition in the futures market, right? Using futures equities, regardless of the volatility, regardless of the volume. Even if you might have doubts, right? Some days are slow and choppy and they take forever to move. However, when we trade futures, it's not all about being in the market all the time. It's not about taking multiple trades a day. It's about finding those key areas and having the patience for those to play out. Some days, there are 0 trades that look like they're high probability. So my goal is to help you guys understand when markets are tradable and that they can be traded in any specific market condition, right? I want to lay that out for you all. So who's this for? If you're here watching this workshop, right, and you fall into one of these categories, I think this is an extremely good place to start. If you don't fall into any of these categories, then you're here just to support me, and thank you, high five. But this is for new traders, right? If you're new to trading, if you've been trading for a while without real success, right? If you've been jumping from strategy to strategy, just confused, discombobulated, and not really understanding where you're going wrong or what really you're looking at. If you feel like it's impossible, right? Maybe you've tried everything, but you haven't necessarily seen something that works in maybe all market conditions or has consistency to it. Or if you're ready to read the markets like a desk trader. So a lot of this, all of this, I've learned from actual professional desk traders, friends of mine that were kind enough to share this knowledge. So I'm passing it down to you. In the next 5 classes, in this workshop, I'm going to show you the best tools, futures trading tools, step by step, to understand how and why futures markets move based on big market participant orders so that you can trade any market condition. So I'm going to show you only 3 tools, right? They are not indicators. They're not specific strategies. It's not some kind of like algo, whatever it is. Just three very specific tools that are very basic that all futures platforms have access to stay consistent regardless of what happens in the markets. So my promise to you throughout this workshop, I will show you three very simple tools that you can apply to the futures market regardless of the market condition. And I want to help you develop a step-by-step system to create self-confidence in how you trade the markets regardless of how fast or how slow those markets move. So if you hear me out today, stay until the end because I'm going to give you a bonus little surprise gift. For the rest of the week, right, you might consider what it is, and it's something of free value. If you stay until the end, just hear me out here. And if you're skeptical, right, we do have a lot of traders with us that trade in our community that have shared a lot of success stories. You can read this out if you want to go check that out, obviously. But this is just one of the many examples, right? You can see this is a whole month of trading in April and just 3 red days of smaller size and just a plethora of green. He's shared with me his journal. So distribution theory, volume profiles, order flow. If you guys were wondering, that's probably what we're going to be talking about throughout this. So in today's agenda, right, we're going to be introducing futures trading. I'm going to give you a little background of who I am, just in case you care. If you don't worry, we're going to be getting into some of the meat for the remainder of the session. But realistically, today is going to be more of a review for some. I'm going to talk to you guys about some of the things that you might not hear constantly when talking about futures. Futures, right? A lot of people just all they look at is how much money people make, right? Is it a viable career path? But I'm going to be breaking down what are futures. I'm going to be breaking down what does one trade future, or how does one trade futures, right? What do you need to trade futures, right? The very basic stuff that you might honestly be missing. Talk about platforms a bit, and then I'm going to also require what is really I'm going to also talk about what is really required to trade futures successfully and break down some of the risk management things that you might not hear about too much, some of the account sizing, position sizing stuff, and understand really the core premise of the futures contract, because it's a very high leveraged asset, right? Derivative asset. It's really very leveraged. So a lot of people do make the mistake overall of over leveraging. They don't understand position sizing very well, among other things, right? So we have to know these bare bone basics before we even take a look at any kind of tools or any kind of market analysis, right? So that's mainly what we're going to talk about, right? It's margins, account sizes, risk management, so on and so forth. And then I'm going to give you guys a little conclusion on what to expect next, because tomorrow we're going to be going through more of how big players move the markets, right? Big player orders. So who am I? Right. I have a background in finance. I have a bachelor's degree in finance. I've lived in Toronto for many, many years. Right. I lived the majority of my life in Toronto. I moved to Europe in September of last year. So I've been in Europe for about 8 months now. So we were originally based in Toronto, but right now I am in Europe, traveling Europe. So this is one of the beautiful things about trading. So I started trading futures in 2018. I traded many different strategies with mediocre consistency. So I've done everything realistically, right? I've looked at a lot of different futures trading strategies, averages, price action, all of that stuff, until I became closer with a few desk traders that actually traded futures professionally. So I was exposed to volume profiles, market profiles, and how to actually read not only those, but actually how to read the market depth, right? The depth of market around 2020. And I found consistency in returns, regardless of the market conditions, in about 5 months after really just beating my head off the wall and finally getting to that point, right? Bought some property in Canada, have been trading full-time for 6 years, and managed to create an investment portfolio with trading earnings, growing long-term wealth. This is one of the things that I've recently been talking about, especially on the downturn of the market at TRADEPRO Academy, how you can turn those earnings into something that can pay you in the long term. So in 2022, I left Canada to go back to Europe and travel and trade. I've been living in different countries for about 3 to 8 weeks at a time, exploring, trading, and investing those earnings. So this is the beauty about it. You don't need more than like 3-4 hours a day realistically to actually trade. And you can do it anywhere, right? As long as the time difference permits, as long as you're willing to trade at those hours. You can even trade the European session, which I do sometimes, and even talk about those trades. Even today, we had one of those trades pre-market. It was about 3 a.m. Toronto time, looking for the longs off those 95s. So it's a very, very viable opportunity. To get this point, though, this didn't happen overnight. It took me about 4 years of wobbling through the markets to actually live how I wanted to live. So it took a lot of time, money, energy, and learning the right things. So the idea is I want to shorten everyone's process realistically so they can reach their goals. Again, I'm not a financial advisor, so none of this is realistically investment advice, but I like sharing my swing trades, investments, day trades, everything for your learning. And I'm going to share with you guys what actual professionals have taught me over the past few years that helped me um, get to this point realistically. So everyone does have a mentor. So why don't we start this, right? Let's get into the meat and potatoes. Enough talking about myself, even though I love doing that. As you can tell, right? Look at this light shining on me. So what are futures? Let's dive right into this. I'm going to break down the very basic core aspects of futures, what they are, what you need to know about futures before you even get started. Like I said, a lot of these concepts are often overlooked by trading education companies, right? Discords, all that stuff. People just blindly get in, follow trades, right? They don't understand the real risks associated with this. And they don't understand the real aspect of what forms or what creates this derivative asset. So futures, they're financial derivative contracts that obligate parties to buy or sell an asset at a predetermined future date and price. So similar to an options contract, but very different at the same time. The buyer must purchase and the seller must sell. So they're highly leveraged assets and they can be divided into many different groups like equities, commodities, softs, etc. I'm going to mainly focus on equity futures because I predominantly trade the S&P 500, maybe like 97% of the time, the ES futures, MES futures, and sometimes trade the NASDAQ, the NQs. We don't hold into expiration, right? Because just like other derivative assets, the futures assets, they do have an expiration date, right? Some expire monthly, like oil, others expire quarterly, like equity futures, right? So we're just mere speculators in the market. We're usually the little fish. Generally, we don't trade hundreds of lots, right? So we don't necessarily have the ability to move the markets, but being able to understand how the big fish move the markets allows us speculators to actually extract some kind of profits from the market, right? We take a gain or a loss. That's the whole point of this for a short period of time, intraday, or maybe a little swing lasting a few days, maybe multiple hours at a time. So futures, they're a centralized asset, right? Meaning that there's one exchange that all the data flows through, focusing on equity futures. Just keeping in mind, I'm going to be talking mainly when I talk about all this, I'm going to be talking about the S&P 500 futures. I think it's the most, well, it is, I'm not thinking, it is the most liquid equity future, and it's one of the best places for newer traders to start, especially if you want to read order flow from a clear standpoint. So they trade through the CME, right? Meaning that we can see all the volume that trades, very advantageous to us. There's no real hidden behind the scenes different exchange volume that has to be gathered, maybe like Forex or even stocks that have multiple different areas that orders do process through. So compared to other assets futures, they're highly leveraged. With a smaller amount of money, you can control the entire index. I'm going to talk about this more later. But they also don't require you to enter with a set premium like options. If you take options for an example, you get into the market with X amount, right? You buy X amount of contracts. So like if I'm buying Apple contracts and they're all $1 each or $100 per contract that yield the power to control 100 shares, if I buy 10 of those, I put down $1,000, right? $1,000 purchases those contracts. Now, depending on if the price goes for me or against me, those contracts lose or gain value. That $1,000 premium either increases in value or decrease in value. When we trade futures, you don't necessarily buy or sell futures in a traditional sense, right? You get long or short, and the profit or loss is dependent on the close of your position. So if you're long and you close it at a higher price, right, you're going to gain the difference. So these futures contracts, they're traded on margin, right? They're not necessarily cash traded, or even would want to cash trade them like the options because they're worth a lot more, right? I'm going to talk about this in a bit, don't worry. So how does one trade futures, right? To trade futures, very simply put, you need a platform that can connect you to data. It's very simple in that regard. Like I said, I predominantly trade the S&P 500 ES futures, sometimes the NASDAQ NQ, their equity futures. You need a reliable futures broker as well as a reliable trading platform, right? There are a lot of brokers out there. There's a lot of data out there, right? Because you have to connect your data to that broker. Your broker will obviously hold your account balance and connect you to the exchange using a data feed, right? There's a list of data feeds that your broker can provide. For example, like CQG, Rhythmic. There's a few other ones that I don't remember, but Rhythmic, for example, isn't necessarily the best data feed that I've seen a lot of people say pleasantries about, if you will, right? It does lag a bit. I do like CQG. There are other ones out there like Denali, for example. That's another one. So you have to understand what the data feed is, because if there's glitches in the data feed, realistically, it can mess up your positions and be very costly. So you have to understand what your broker provides if you have a good broker, so on and so forth, and a reliable trading platform. Not all platforms serve the purpose I need as a futures trader. Some of them have very high margins. Others don't have order flow tick by tick data, right? So you have to understand what each platform provides. You also don't necessarily need 10 monitors. I use about 2 right now. Anywhere from 2 to 4 is enough. Seeing all those like big desk traders that have like multiple monitors, right? A lot of them are bond traders or trade multiple assets at a time, but it's not a necessity if that's something that you were wondering. When we talk about platforms and brokers, futures trading platforms that I would recommend looking into, Sierra Chart for me, I think is the best, cheapest, and most customizable option. There is a steeper learning curve in Sierra Chart, but I think that this is the ideal charting software for futures trading in my personal experience. Jigsaw is another one. It has the best depth of market. It's kind of just like laid out for you. So I know a lot of people do use that, especially for execution. Bookmap, it's pretty good for visual learners. I haven't had any experience with it, but I know a lot of people rave about its visuals. In terms of brokers, I use AMP Futures. I haven't really looked even into other ones. AMP Futures is a discount futures broker. Obviously, there's interactive brokers as well, and Thinkorswim for the American people. But if you use it just as a broker, it could be fine. But realistically, in terms of charting, they're both extremely far away from what Sierra Charts offers. So what do you actually need? After years of trying different things, going through all the market has to offer, making all the mistakes, I learned one specific thing that I want to share with you guys. Day trading futures successfully requires the understanding of what actually moves price, right? By the time I understood this and by the time I understood what to look for, I had burned a decent bit of money. I had gone through multiple different strategies, different ideas, trying things out, seeing what didn't work very easily. And what actually moves price is volume and orders. So no moving averages, no price action, no candlesticks, no patterns, no indicators, none of that, right? Just basic volume and orders. Now, there are tools and charts that visualize volume and orders for you. So it's not like I'm magically just plugging these numbers into my head somehow just by trading or looking at one specific thing. There are charts that do reflect this on a visual aspect, which I'm going to talk about throughout this workshop. But the main volume and orders, right, that's what is going to move price. If there's a lot of buy volume, price expected to go up. If there's a lot of sell volume, price expected to go down, right? That's a very easy concept, but where do you extract that information from has always been a puzzling aspect for me. And those are the 3 tools that I'm going to introduce throughout this workshop: volume and market profiles and the depth of market, right? Very simple. I already gave away some of the secrets. So 3 general tools that I learned from desk traders that work constantly, because volume is going to move price. Price isn't going to start running and then volume starts appearing. It's just not how it works. We're in the lowest volume period of the market generally in the summer, right? The summer season is the lowest volume and volatility season. A lot of traders, even professional traders, find this very, very difficult because they've been either spoiled with volatility and volume, or they're used to trading trends and larger moves. However, each time summer comes around, and everyone that day trade loses their minds because the moves are hard to read, strategies do go out the window, right? You see a lot of mistakes being made, and a lot of seasoned traders actually just step away and say, you know what, I'm going to come back when volatility comes back. One thing does stay the same: reading how volume enters and leaves the market. regardless of the move, bigger, small, faster, slow, volume is still going to lead us to see what the potential of the legs are, right? So what do you actually need? Three constant tools, right? Very simply laid out for you guys. Volume profile. Right? I'm going to talk about all the different volume profiles, what the volume profiles represent, how to actually use them, right? I'm just laying out the very basic needs here, or the necessities, if you will, for actually trading futures markets. But the volume profile here, we have this blackish chart, darkish chart, and on the right hand side, you have a volume profile. On the individual sessions, you have volume profiles, right? These allow us to identify where markets have balance or imbalance, right? Market profiles give us it's a very common tool used that's close to the volume profile, except it is generated based on time, right? We're going to talk about that and how you can find discrepancies in market profiles to identify moves. And finally, the depth of market order flow. So the depth of market allows you to see how contracts trade against each other, right? How buyers and sellers react against each other, where stops are, where stuck traders are, and how those moves come about, how bearish and bullish DOMs form, right? So you can actually get a bias and directionality in the market to build your confidence. So all of these tools put together, you'll notice there's not a single moving average, there's not a single candlestick, there's no charts on this. So if this is something new to you, then I hope you're interested, because this is all you theoretically need. I'm going to obviously introduce a candlestick chart just as a visual. I'm not going to do anything with it. It's just a visual, so you can kind of, because if you're so accustomed to seeing candlestick charts, it's very difficult to just look at these two things and be like, okay, I know what I'm doing. It's a lot easier for your brain to process what a candlestick chart looks like and what the moves look like. But it's going to be difficult if you're used to looking at price action, higher highs, higher lows, blah, 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 right? I'm not saying that has no place. I'm just saying that for this purpose, I'm going to be focused on volume and how the volume actually moves the market. So these are the main tools that we're going to be covering throughout this workshop, right? This is it. That's all you need. It doesn't require multiple monitors, right? These three constant tools, if we talk about volume profile, it allows us to see where large distributions are, right? Balance or imbalance areas, which can dictate the market's direction and the expectations of a move. So it allows you to see where strong-handed market participants enter and have entered the market. It allows you to find large market inflection points. These are the highest reward moves, right? They're not the easiest to catch as well, right? You might have to ping them once or twice. And speaking of those, right, today, if you guys follow us on social media or if you're in our Discord, you've seen our trading plan. The trading plan was try to short into the 4,200 down into about the mid 70s. The mid 70s was expected to be an inflection point, and now we've rallied over 20 points. So it's those things where we can I don't want to say predict. That's a BS word. I'm not predicting. I'm anticipating based on the information that we have and confirming based on the information that we have. So very simple 20 points moves down and up, just using these two charts and understanding how volume had traded in the prior sessions. So market profiles, they allow you to see where the majority of traders come into the market. They allow you to see unfinished and finished auctions. They allow you to see unfair balances and rejections, right? So they can give you a very good understanding of where key support resistance areas are and where weak-handed or strong-handed traders find themselves. The depth of market order flow, this allows you to see all of the orders that are coming into the market, right? It allows you to see big buyers and big sellers, how they react, if they're real, if they're fake, if they're getting stuck, if they're accepting, right? Who has strength in the market, the buy side or the sell side, and what high probability entries are based on all this information. So you're seeing literally all of the orders coming in and who actually is winning in the market, so you can join that winning team, right? Once you understand how to read the depth of market, you start to see these things extremely clearly. So if we can master these three tools, we can increase the probability of our success in the market. So traders can find out where the market is headed with the combination of these tools with high probability. So these are the tools that we use on a daily basis to create trade plans and trades and, right, have even somewhat of a bias. So it's not always incorrect to have a bias the bias depends on the levels that you trade realistically, right? So read the last line of this breakdown. This is a plan that I drop down for our members every single day. And the last line says longs at 41.37 to 40. That's the plan. Let price drop down to that area. That's where there was a lot of buying in the prior sessions. That's where a lot of volume accumulated. That's where a distribution area is where price will want to find balance, so on and so forth. That is the expectation of the market, right? Whoops, I feel like I already broke that down. So this is it, right? The plan using the volume profile and the market profile that laid out where the strength of the market was, right? I'm looking for those longs into 37 to 40. I know it's a 3-point range, but into that area. So you can see these are longs from 39, multiple longs, 3 longs off the 39 based on the expected direction from the volume and the market profile, right? Even before the market was open, we had an idea of what should happen and how it should happen, why it should happen, right? So this is the power of understanding volume and how volume actually moves the markets. 3 trades off the 41.39. One was for 11. The second was for 11. The final was for 20 points. So I'm not saying that every trade is green, every trade is great. Today I took like 3 stops trying to buy into those key areas, right, that we had laid out. But eventually, once we get that 20-point move, that 25-point move, those prior losses, they become just wiped out realistically. So this right now is one of the main aspects that a lot of traders overlook. Talking about notional value and the margin, right? Which leads into account size, position sizing, all of that. You have to understand in depth the product that you're trading because a lot of people they look at futures and they want to take a couple of $100 and turn them into a couple of hundreds of thousands, millions of dollars. It's not a lottery ticket. It's not how options used to work in 2021. It's not trying to pick up these like massive giga moves. Realistically, these are very sophisticated, highly leveraged contracts and derivative assets. It's not something that you can open an account with $200 and start playing and expecting to make these massive returns. You have to understand what the real value of a contract is, because then you'll realize what account sizes should look like, right? So you can better prepare yourself. So it's not one of those things where you're gambling into the market or you're taking it not very seriously because it's a smaller amount of money. So there's a lot of positives to understanding what the leverage and the notional value of these contracts is. Highly leveraged, right? The notional value has to be defined and it defines your risk, right? The better you understand this, margin and leverage, the better you can understand the asset you're trading. So it's going to open your eyes to the account, to the size of the account that you need and what it really takes to trade in this market. So for example, let's take the S&P 500, right? We're going to look at the minis, which are at the top, and we're going to look at the micros, which are at the bottom. So if we take the minis, right? The minis are 50 times the index, right? So 50 times the index. Let's just say the index, just for easy calculation, the index is at 4,000. So 50 times 4,000, that's $200,000 per singular contract of notional value, right? It's a lot. Now, if we take the micros, 5,000 times 4,000, right, it's $20,000 of notional value per contract. Now, consider what the margins are, right? Okay, we're using different numbers here. So 41 and 41.50. So again, about 200,000, right? Consider what the margins are. Your discount broker, right, AMP Futures, whoever the discount broker is, they offer you E-mini contracts at $400 a contract. They offer you micros at $40 a contract. This propels a lot of newer traders to come in, open an account with $1,000 and start trading minis, right? Because you only need $400 to trade one mini. This is, yes, it's one way of looking at it, but realistically, especially if you're a newer trader, the concept of risk management is still probably foreign to you, and there's probably some kind of gambling fallacy when you see losses in the book. When you take a regular broker, for example, Interactive Brokers, right? They offer minis at about, right? This is the ballpark figure. E-minis are at $10,000 per contract and micros are at $1,000 per contract, right? These larger brokers, they're trying to not only protect themselves, but protect you, because these are very highly leveraged assets. And they do require more sophistication when trading. So when you look at a discount broker and you throw in $1,000 trading minis, right? You take like one trade, two trades, and the account's gone, and you can no longer trade that size, right? Same thing with micros. You look at micros, $40 a contract. Let me throw in $200, see what happens with that, right? It's not the best way of looking at this. There's something to be said about this massive discrepancy. If you take a discount broker, the leverage is about 500 times. Regular broker leverage is about 21 times. You can see there's a very, very clear difference here. So, general misconception that you need a very tiny amount of money to start trading futures. You don't need a lot, but it's not as small as you think, right? It's not true, and it presents a lot of problems, especially with low leverage availability to newer traders, or sorry, higher leverage availability to newer traders. So it's a good thing and a bad thing, and you could also start with a small amount or not, right? There are a lot of conditions here, so I do want to break these down. Consider a general stop. My general stop is 3 points. Let's consider a 3-point stop on the S&P 500 E-minis or the micros, right, per contract. So ES, $150 per contract. The risk is defined risk. I'm not taking more than that, right? And I'm not taking less than that. I've defined it. So the MES is $15 in that same capacity. If you risk 1 to 2% per trade, right? Let's say an extreme max, which I don't necessarily think is needed, but let's say an extreme max of 5% on the account daily. That's your risk. This allows you 14 losing trading days of your 5%, right? Of 5% of your account before you've hit 51% of your account, right? Based on this. So assume that 1% of the account per trade, or 5 trades per day, one lots, right? So let's say the E-minis is $15,000, right? That 1%. So that means realistically, if you're looking at it from this perspective, you need you need $15,000 in your account to $18,000 to trade one E-mini, right? Which is more than the margin of the interactive brokers, or like the larger brokerage, right? And it's way, way over the margin of the discount broker. You look at MES, same thing. You need $1,500 to $2,000 to trade one micro based on these assumptions. So, for example, trading 3 minis, you need around $45,000 to $54,000 in the account, right? Seems like a lot. Now, you don't have to go to this extreme and abide by this, especially if discount brokers are available, right? So it might be a little discouraging. Why the hell is E-mini margin $400 then? Why is that the case at a discount brokerage? There are conditions naturally. Discount brokerages, they're notorious for constant resets, blowing up accounts on smaller accounts, and less experienced traders realistically, right? There's not many like big traders out there that use discount brokers realistically. There's no professional traders that do it, right? Or use discount brokers that have such low margin availabilities. Because this should realistically instill discipline. Understand what it takes and where to start, right? Scaling and growing from ground zero, base one, meaning that realistically, if you do have under 10K in the account, start with micros. Consider starting with micros, right? I think it's a very, very important rule, especially once you saw what the notional value looks like. Now, I'm not saying abide by these rules. Don't get scared. Don't run away. You don't have to have 100K to trade minis, right? A lot of people do think so, but I don't necessarily think it's necessary. Necessarily think it's necessary, right? Whatever. So you can start with $1,000 per contract per micro, right? I think that's fair, regardless of $40 margin, whatever the case is. I think anywhere between like $700 and $1,000 per micro contract in your account allows you to trade one contract, right? I wouldn't recommend having too much less. Per mini, between $5,000 and $7,000, I feel like is a fair amount, right? So suppose you have about $20,000 to start trading. I would highly discourage you from putting it all into the account and starting with minis. That is the last place you want to be. Consider $2,000, trade one micro, maybe 2 micros, and after you've demoed for about 2 to 3 months, right? Fully immerse yourself in the strategy, in your system, in something that I'm going to be teaching you throughout this week, and then gain consistency, confidence in your strategy, move on, and ideally, the first account does not turn into tuition, right? Maybe half it does. You gain some knowledge, some confidence, and then you can start moving money into there instead of having the 20K, starting with the minis, blowing it out and being like, what the hell do I do now, right? Baby steps, right? Baby steps, because trading futures, baby steps, they turn into that you go from crawling to running extremely quickly. Once you have gained the consistency, once you've gained the confidence, you're not crawling for very long, right? It's a very, very small difference between making like $0 negative $100 to making like two, three, $1,000 a day realistically. It's not a big difference. It's not a big step if you do this properly and you do it with discipline, because the number one thing is discipline. So when it comes to positioning, trading one lots and micros at the beginning, maybe a few lots on micros, but micros I highly, highly recommend. Even sometimes when I don't feel 100% or I can't read the general movement of the market extremely well, I still hold into micros, right? Like I'll trade like 7, 15, 25 micros rather than trading multiple lots on the ES. I think micros are one of the best things, and I wish that when I started trading futures, micros were around, right? It would have saved me a lot. So the goal is to create a strategy that has good results, consistency, and builds confidence. Micros generally a stepping stone, right? They are a stepping stone for a lot of people, or they can also generate really good income, right? On Friday, I think I was trading only micros with the team, even on that big trend day, right? Or I can't remember. One of the days I was trading micros with the team, and still it was like a multi-$100 day. So you can still make consistent returns with micros. You shouldn't be afraid of them. They allow you to learn, they allow you to develop your strategy and your system with little risk in comparison to minis. You have to let go of the idea that the money is going to be made on your first day of trading, right? Demo is very, very different from live, and we're going to be talking about this at some point, right? So when we define risk, I think futures trading and risk ties very, very well into scaling, talking about position sizing, and it's the most important aspect of trading, right? You want to you want to limit your risk, increase your risk management so those returns can come progressively, right? So that's the main thing that you want to focus on. Focus on not losing and losing less. Then everything else comes easier. So define risk. This means that you should be aware of how much you stand to lose on every single trade. I do not recommend having open stops or no stop at all. Having a mental stop. I'm gonna get out when this price is hit. That's bullshit. I don't think anyone does that. Right. I just don't, right? You see it go against you, like, whatever, it'll come back, and then boom, account's gone. So each trade has very different probabilities of success, and it's extremely difficult to calculate the income. We just know if we have a higher chance or a lower chance based on the system. That's the importance of developing a system, because you know that, okay, based on my system, this trade that I'm about to take usually hits or usually doesn't. So that means I can change my position sizing. I don't think every single trade should be sized the same, right? I don't think every single trade is a full size trade. So that's another thing that we're going to learn. Defining risk means keeping to a stop without moving it until some profit is taken realistically. That's how I like to trail. But the core concept of that is you have a stop, you don't move the stop, right? You abide by the stop, you respect the stop. Always have a hard stop. Always have a hard stop. In futures equities trading, day trading, I use a 3 to 4 point stop generally when trading the S&P 500 futures, 10 to 15 points when I trade NASDAQ futures. And then my initial take profit is about 1.5 to 2 times the risk that I take. So if I take a 3-point stop on S&P 500 futures, 6 points is my first target, and then I try to scale out at higher areas or better areas. So let's take a look at that at a trade that played out in the room. This is Trend Day Friday, one of the better days. Trend Day Friday was amazing, right? We identified the trend earlier on. Again, using very simple concepts that I'm going to talk about, volume and market profile. Simple. So longs from 41.83, right? Through this in Discord, using I use a 3-point stop unless I specify as different. So the max risk is at 80, 3 points per contract. Target to trim at 2x usually, and then try to trail out. So you can see the final take profit was at 10. That was the overall target on this move, but didn't hold the full position for it, right? I like to trail, I like to trim, because I can put money into the pocket and put it on the board. So I really focus on risk management and how we can really define our risk and then really cut our risk down. So remaining targets are key areas that are marked by distributions, right? Very key ledges, distribution profiles, tops, bottoms, whatever the case is. So this are defined risks. Let's take a look at how this trade played out. The defined risk profile is 9, right? a 9-to-1 risk to reward. So risk is 3 points, max take profit is 27 points. I'm not saying that every single trade is a 9, right? But I think that all trades should be 1.5 to 3 in that range. That's why we focus on this system, regardless of the market conditions. It's possible. May, no different than any other month. Today was the final trading day of May. Yeah, I did have some slip ups. I got some paper cuts, but overall, right, I'm taking 15-point profits on average for 3-point risks. So that's the idea, regardless of the market conditions. So always have defined risk in the futures market because leverage is super high. If we compare this to the options market, right? Let's say in options, if you want to buy one option at $200, you know your defined risk. It's $200. That's the max loss. If you buy options, I'm talking about buying options. Let's keep it simple. No selling options. We're buying options here. If I buy options for the underlying to go up or down, I know that I stand to lose $200 regardless of what happens, right? That's the max I can lose in this scenario. You can have a stop, you can lose a little less, but I know no matter what I do, if it goes against me, fully I'm out $200. In futures, when you enter a position, right, your exit determines your profit or loss. If I get into a long position and it runs against me and it drops 20 points, I'm down $1,000. Right? If it runs 30 points, I'm down 1,500. If it drops 5 points, I'm down 250. My max loss is my account size. It's not a predetermined premium. This is why hard stops, in my opinion, are a must, because humans are emotional and they're not going to abide by their mental stops, right? I don't believe in that necessarily. So speaking of emotionality and the human touch to trading, it's a very psychological career. It's not learn the theory and apply it and it's guaranteed success, right? This is far from it. This is why risk management is super vital, and becoming a good loser, you will eventually be able to navigate the markets in a much, much better way. A good futures trader realistically probably has a percent profitability of around 60, 65. These are guys are successful on the higher end of better traders. Some even at 50%, right? With a good risk management and an R&R, all these desk traders, they earn millions realistically, right? They're willing to take these risks because their risks are defined. It's very simple in their regard. So understanding market psychology and the thought process of big money traders is what can help you understand how big markets or how markets move, right? Where expected orders are, where stops sit, right? Where active traders are expected to come in. This is what we're going to be focusing on when we identify the market moves and causation for the phenomenon of distribution theory / auction theory, right? This is going to be the main concept of what we talk about and what we do at TRADEPRO Academy. So with that, I do want to thank you for your attention. I don't even know how long this was, honestly. It's been 45 minutes. I think that's a pretty good time. So I want to thank you for your attention. I want to thank you for sticking it out. This was the first day of the workshop where I kind of drilled in some things that maybe you've never heard before, maybe might have scared you, but this is the reality of it. And my goal is to be as real as possible when it comes to this industry, because it is highly risky and there is a lot of leverage that can result in amazing gains and an amazing lifestyle if done properly. So that's my goal here. So we did cover a lot, very, very basic information you may have not known. Regardless, just like anything else, we need to start somewhere and we need to start with a foundation, really build down a base. And don't worry, we're going to be kicking into high gear soon, right? I'm going to be talking about market participants, their psychology, and how they manage to move markets, right? Where their trades are, how their stops look, where their stops might be. But first, right, I want to give you guys a bonus for sticking around. Over the next 2 days, Thursday and Friday, we're going to be opening our live trading room in the morning for all of you to attend. Just check out community.tradeproacademy.com to enter that free Discord and jump into the community voice every morning at 9 a.m. Eastern sharp. Join us in that Discord. So Thursday and Friday to end out this week, I'll be in there live trading with you guys. So I hope everyone joins me for that after today's first session. And if you stick around till the end of this workshop, right, meaning on Sunday, we're going to be giving you a much, much larger gift. Just like in the markets, patience will pay. And I hope to see you guys all in the next few days in the live room. So that's it. That's all I wanted to present to you guys today. I'll be sending a recording at the end of this with a little email. So check out your emails. Keep an eye out on your emails. And tomorrow we're going to be talking about the introduction to futures, markets, and participant psychology. How do market participants move the markets? following big orders in the markets, auction and distribution theory, a little intro before we get into the meat and potatoes of balances, profiles, and all that stuff. So that's how I wanted to end this. I'm going to look at this